Let us examine irrational exuberance, fueling the surge in stock prices. Irrational exuberance, fueling the surge in stock prices. Investor behavior most of the times, govern market movement. you know, you would expect fundamentals to really, be considered key in determining stock prices, but all the same, you know, human behavior play a key role. Let's look at number one: overconfidence in market growth. Overconfidence in market growth. Irrational exuberance occurs when investors exhibit excessive optimism about market performance, believing that the stock price will continue to rise indefinitely. Of course, trees don't grow to the sky. This overconfidence drives demand, pushing price higher. It pushes prices higher without regards for underlying fundamentals such as earnings or revenue growth. People will just disregard fundamentals and they keep on bidding the price of company that ought not to even grow at all in price. They just keep on bidding up the price because of overconfidence that the stock will keep on climbing. It doesn't happen like that. Number two is disregard for valuation metrics. Disregard for valuation metrics. All these things are characteristics of irrational exuberance. During periods of irrational exuberance, traditional valuation measures like price to earning ratios, price to book ratios, and dividend yield are often ignored. They are disregarded completely. That's why people pay the price at the end of the day. Investors focus on potential future gains rather than assessing whether current prices reflects a company's true value, leading to inflated stock prices. Number three is fueling speculative investment. Fueling speculative investment. Investors are more likely to engage in speculative trading during periods of irrational exuberance, chasing high risk, high reward opportunities, momentum investing. This speculative behavior inflates stock prices, particularly in emerging industries or trendy sectors, as seen during the dot-com bubble and the cryptocurrency boom. Some sectors could tend to be affected by this behavior. Number four is amplifying market momentum. Amplifying market momentum. So rising prices during irrational exuberance creates a reinforcing cycle. As prices climb, more investors enter the market. As more investors enter the market, it will then further drive, demand, and prices will still keep on climbing. This momentum effect often leads to unsustainable price level, increasing the likelihood of a market correction. Of course, the market will always self-correct. It's a very important component, behavior of the market. At a point in time, market correction will set in, bringing all those high-flying stocks to their true value, to their true worth, if not lower than that. Number five is igniting FOMO. That's fear of missing out. Igniting FOMO. Please subscribe to this channel and give this video a like, thumbs up. Irrational exuberance generates widespread FOMO, encouraging even cautious, risk-averse investors to join the rally out of fear of missing potential gains. When your neighbors are discussing their gains, your friends, you want to participate. So this influx of new investors accelerates stock price inflation, detaching price further from their intrinsic value. Nobody wants to miss out of a booming stock market, and they keep on fueling the boom that will eventually burst. Number 6, ignoring economic indicators. Ignoring economic indicators. So during periods of exuberance, investors often disregard broader economic indicators such as GDP growth, inflation, and interest rates. Instead, they focus solely on bullish market sentiments, which can create a dangerous disconnect between stock prices and the overall economic environment. They ignore what they ought not to ignore. Ignore inflation, they ignore GDP growth, and they equally ignore interest rates. And that ignorance will then cost investors at the end of the day. Number 7 is increasing market volatility. Increasing market volatility. Irrational exuberance, often leads to extreme market volatility. As stock prices, rise rapidly, any negative news or sentiments, can trigger a sharp sell-off. The market has gone to a level, it's simply waiting for a negative news to bring those expensive overpriced stocks to their true value. This volatility destabilizes markets, creating uncertainty and increasing the risk of financial losses. So in conclusion, rational exuberance plays a significant role in driving up stock prices by fostering overconfidence, speculative behavior, and disregard for fundamental analysis. While it can create short-term gains, we know about that, it often leads to long-term instability, making it essential for investors to remain grounded in market fundamentals to avoid the pitfalls of excessive optimism.